Hello guys, good evening. I hope so you will be fine. Please confirm through the chat option. Am I audible? So guys, we are discussing unit 3 today. So please remember, we are into this section. The section name is financial statement analysis. Okay, this is one domain of CMA syllabus and this domain is, this section is 20% of your exam. So it has three units. Unit number one, which was about liquidity, solvency, and leverage ratios. Unit number two, it was about profitability and per share ratios. So these two units have already covered. So it's a unit three today, and we are talking about activity ratios and earning quality. This is again, as I told you, it's a part of financial statement analysis, okay, which is going to be 20% of your exam. So in this unit, I need concentration. So we got two main topics. First, we got here activity ratios 3.1, and then we got another topic which is about ratio analysis and earning quality. This is more about theory. But the first 3.1 is more about ratios and calculation. So here we go. First 3.1 we are starting. So we are going to discuss about activity ratios, okay? So guys, activity ratios generally what it measures how quickly two major non-cash assets. Which non-cash assets I'm talking about? I'm talking about account receivables and inventory. Like how quickly the two major non-cash assets are converted to cash. So that's called activity ratios. Okay. Like for example, if you have receivables, how quickly you are converting receivables into cash, or if you have inventory, how quickly you are converting your inventory into cash. So that is activity ratios. So here this is just balance sheet data in front of you. Okay, this data will be used throughout your examples here. So for example, this is the balance sheet, let's assume. So this is the asset side, which is resources. Okay, and this is financing side, means your liabilities plus equity. That's financing side. So on asset side, we got here some current assets, which includes, and also remember this data is for 2 years, for the current year and for the prior year, means the last year. Similar way, we have liabilities and equities for the current year and for the prior year. Okay, so first I'm starting with the current assets. We got some current assets, for example, cash and equivalents of the current year and the prior year figure. We got some available for sale securities. It's also your current assets, account receivables, note receivables, inventory, prepaid expenses. So these are your current assets. And here we got a total of current assets for the current year and for the previous year. Then we got it here some non-current assets, for example. So we got equity method investments like investments, long-term investments. We got property, plant, and equipment. Okay, we got their depreciation also. This is the cost of PPE. These are the depreciations. Okay, and then we got intangible asset like goodwill, etc. So we got here total non-current assets. Okay. Now on the other side, okay, we got it here first current liabilities. Okay, we got, for example, accounts payable, notes payable, interest payable, accrued interest. Okay, current maturities of long-term debt which is payable within 1 year. That's your current liabilities, accrued salaries, income tax payable. So this is what is your, these are your current liabilities, total current liabilities for the current year. This is for the last year. And here we got some non-current liabilities like bonds payables, long-term notes payable, employees related obligation like pension related things, deferred taxes. Okay, so here we got the total of non-current liabilities. And then if you will add these two figure like current liabilities plus non-current liabilities, this is your total liabilities here. Same here, current plus non-current is total liabilities. And then we got it here equity also. And equity, in equity we got preferred stock, common stock, additional paid in capital, retained earning. Okay, this is the total of current year, this is the total of non-current year. And now if you will add total liabilities plus equity, this should be equal to the asset now. Total liabilities plus equity, it should be equal to the assets. You can check it here. This is the general rule for the balance sheet, we know. Okay, like this is the data. We don't need to focus on all on whole balance sheet here, no, because we are talking about today mainly about receivables, inventory, and payables we will talk about. So then guys, we got it here down. We got it here income statement also. Again, we got income statement for 2 years period for the current year and for the prior year. And here you are provided with the information, okay, of net sales. Then we got a cost of goods sold. We know we take sales minus cost of goods sold. So this is how you get gross profit. Then we deduct selling and administration expenses. So this is called your operating income. And data is available for the last year and current year. Then we got some other revenues and losses. Okay, so then we got earning before interest and tax, then we deduct interest expense. This is equals earning before tax, and then we deduct income tax, and this is your net income. So income statement is also given. Okay guys, one thing you should remember, okay, one thing which is really really important. Okay, so in activity ratios, now I'm starting the topic. In activity ratios, generally, ratio mean to say the linkage between two things. This is what is called ratio. We know this linkage of two things. We are trying to connect, linkage between two things, two items, any two items. And in activity ratios, generally, we will take item from the balance sheet also. We will pick some figures from the balance sheet, and we will also pick some figures from the income statement also. Okay. Then we will see, okay, about receivables, inventory, and payables. Now, guys, first thing we are going to talk about, these ratios are not difficult at all, but being a student, you need to memorize the formulas and you need to understand the interpretation. Okay, what's the interpretation and from where you will get the component of the ratio to calculate it. So this is what you need to understand. Now here, first thing we are going to talk about, we are starting with the receivables, accounts receivables. Okay. Regarding receivables, we will answer two things, guys. Okay. We will talk about one ratio which is called turnover ratio. Okay. And second, the ratio we will talk about collection period. Collection period is also called average receivable days. It's also called days sales outstanding. These are different names they can use. Okay. You have to just remember. So the most common name we use collection period or turnover ratio. Okay, these two ratios measure two different things. Okay, this ratio, the turnover, will always give you answer in times. For example, 10 times, 20 times, 50 times. So what it means, this will tell you, this turnover ratio will tell you like the receivable, whatever receivable you have in your financial statements, how many times you converted these receivables into cash. For example, if answer is 10 times, let's assume, I'll show you the ratio, don't worry. But let's see if you know the answer of this turnover. So it will show that 10 times you have collected cash from the customer in a specific period. Okay. Or 10 times your receivables were converted to the cash in a specific period. This is what turnover. But this collection period would be generally in days or it could be in weeks also. Okay, so but the point is, So for example, 10 days, 50 days, maybe 3 weeks, 4 weeks, like it, the collection period answer will always be in the days. And what it shows, collection period will tell you, for example, if answer is 30 days, let's assume, collection period will tell you on average we are collecting cash from the customers after every 30 days, or customers are taking 30 days to settle their payments. It's the same thing. Okay, these are two different ratios. Turnover, turnover, we always want high turnover, and we always want lower receivable days, because whenever turnover will be high, automatically days will be lower. Okay, because as a business you need to think, you should recover, you know the cash from the customers more times in a year, not few times, more times in a year. So answer should be higher for turnover. And for the days, what do you want? Do you want your customers to pay after 90 days or 30 days? Definitely you will prefer 30 days. So that's why the preferable answer is, so turnover ratio should be higher and collection period should be lower. Okay, then it is good sign for you. Now the question is, how would you calculate the turnover ratio? So I'm starting first with the first ratio, which is called account receivable turnover ratio. And turnover ratio, this is the formula for account receivable turnover ratio. Okay, you have to memorize these formulas, guys. Okay, so account receivable turnover. Okay, how you will calculate? As I told you, turnover will give always give you answer in times. Yes, I told you. Okay. And we want higher answer, not lower answer. Higher answer is better for the business. But the question, how you will calculate, and this is the formula you will apply. So you will take first thing, the first thing you will take net credit sales. And you can see this is written net credit sale. In your exam, if he told you, for example, cash sales, credit sale, and then the total sale. So please remember you have to use credit sale. But if in your exam, he didn't tell you cash sales and other thing, he just told you total sales, then that total sales means a net means a after sales return. So that net sales you should take it. Okay, and we know this net sale figure from where we will get. This net sale figure we will get from the income statement. Okay, net credit sales, priority is net credit sales. Okay, if net credit sale is not given, so you can use net total sales, it's fine. Okay, and the denominator, if you will look at here, the denominator in the formula is average account receivable. Average, how you calculate, guys? Average generally, as I have shown you, so we are provided 2 years balance sheet data, right? So whenever you calculate average, this is how you calculate. Okay, if data is available on yearly basis, for example, we got current year and we got the previous year or the last year. Okay, for example, he told you receivables, current year receivables are 100,000, last year receivables are 50,000, let's assume. So how would you calculate average? Because we want average, this is how it is calculated always. So you will take opening receivables plus closing receivables. Okay, or the last year receivables plus the current year receivables. It's the same thing. Divided by 2. Why 2? Because these are two figures which you are trying to average. Okay. So opening receivables, it means this is how you will calculate average. For example, last year receivables were 50,000. Current year receivables are 100,000. Okay. Total is 150 and divided by 2. So average will be how much? 75,000. So this average you have to use. Okay, now once you will divide net credit sales with the average account receivables, so you will get what? Turnover ratio answer. Okay, and turnover implies that how many times we converted our receivables into cash. Okay, now guys, that's great. But here I'm adding another point. It might be tested in your exam also sometime. Because when you work with the receivables, okay, especially with the average, especially with this average, I'm talking about average. Okay, I told you how you will calculate if data is given on yearly basis. But here is one note is there, this note. You need to understand this note. They're saying if a business is highly seasonal. Seasonal means maybe in January, February more business, then maybe March, June, March, April less, then maybe May, June more, like that. Seasonal. Okay. So then a simple average. This was the simple average, opening receivables plus closing receivables divided by 2. That's a simple average. They're saying if the business is highly seasonal, if a business is highly seasonal, then simple average, this average which you have calculated, it's not appropriate. Then what you have to do? You should calculate monthly average. Monthly average how? But this is, I don't think so they will test in the question. Theoretically they can test. Monthly average how? So let's say you have a data of January, February, March, and so on. He will tell you the receivables, okay, of every month, for example. So then what you will do? You will take receivables of January, February, like Jan receivables plus Feb receivables, okay, plus March receivables, and so on. For 12 months you will do, okay, and you will divide with the 12. This is called monthly average. Okay guys, one more thing, sometime he might give you date quarterly data. For example, quarter 1 quarter, like Jan to March. Quarter means 3 months. Quarter 2 data, okay, like for example April to June. This can also be tested this way. For example, he might tell you receivables at the end of first quarter receivables were 2000. At the end of second year quarter receivables were 3000. Maybe you are calculating ratios for quarterly data. Then how you will calculate average? You will take quarter 1 figure, the end of quarter 1 figure plus end of quarter 2 figures divided by 2. This is how you can get the average. Okay, this is what is all about turnover ratio. Now we just need to talk about, okay, some uh, formula. I have explained now this data he has used, okay, from the balance sheet current year, prior year. So this is the same formula that you have to take net credit sales from the income statement divided by average receivables. Average receivables, how you calculate opening plus closing divided by 2. Okay, this is what they have used here. Okay, now we need to understand here. Okay, if you will just look at here first, look, let's see, we have calculated and we got these answer. What answer we got? In the current year, we got turnover ratio 15.3 times, and in the prior year it was 12.7 times. Tell me, your turnover ratio has improved or not? Yes, it has improved. Last year your receivables were converted 12.7 times into cash in whole year, but in this year your receivables are converted 15.3 times. So it's better, your ratio has improved as compared to the last year. Okay, now here we got some points. So these points, by the way, I have already explained, but just I'm trying to link now. They're saying that uh, a high turnover, for example, if turnover answer, turnover ratio answer is higher. If high turnover is there, it implies that customers may be paying their accounts promptly. That's why turnover is high, that we are converting our receivables into cash more times. Okay. Now, if you remember turnover ratio answer, let me write here. Receivables turnover I'm talking about. Turnover. What's the formula? Net credit sales divided by average receivables, account receivables. Okay. Trade receivables, I mean to say, and then this will give you answer in times. Okay, now the question is that high turnover ratio can be higher when you are, even if when your numerator will increase or if your denominator will decrease. If any one of thing or both of these two things will happen, so turnover ratio will automatically increase. It means what you have to do, you should, if you want to improve this ratio, so you should have more credit sales, okay, or you should have less receivables. Okay, that's what is the high turnover. Now, if turnover ratio is lower, how turnover ratio could be lower? If you will reverse it. Okay, if you will reverse it. So reverse means, say for example, your turnover ratio will be lower if your net credit sale is lower or if your average receivable is higher. So in that scenario, your turnover ratio automatically will be lower. Okay, and if turnover ratio is lower, it implies that customers are taking longer to pay. Okay, or we are not converting our receivables into cash quickly. That's what it means. Lower turnover. Okay, this was all about turnover ratios. Now, as I told you previously, like regarding receivables, we got two ratios. One I told you that is turnover ratio. Okay, and second is collection period. And collection period is also called days sales outstanding in receivables. Outstanding. It's also this other name. Outstanding in receivables. Or it is also called receivable days. Okay, any name he can use, please. You have to remember. Now here, guys, here we got, if you want to calculate collection period, we got two ways to calculate it. Okay, so first way is what? This is the first way. If you want to calculate collection period, the first way is what? This is the formula first way. Okay, this is the first formula which is written here. So you will take days in a year. Okay, generally in exam they will tell you how many days are there in a year. So it could be 360 or it could be 365. You have to check the question. Most probability he will express the number of days in a year. So in mostly in US exams they take 360, but if they are telling you days in a year are 365, use 365, otherwise use 360. Okay, so days in a year, we got here days in a year, and then we will divide here with the answer of account receivable turnover. Turnover, you just calculated above turnover ratio. What was the net credit sales divided by what? Average receivables. Okay, that is the turnover. The answer of turnover ratio you will divide. For example, let me tell you here. For example, 360 days, I'm assuming. Okay, and divided by turnover ratio was, for example, 10 times. We will divide with the 10 times. So 360 divided by 10. Okay, whatever answer you will get, it will be how much? 36, right? So answer would be 36 days. Okay, 36 days. So 36 days means what? They are showing that the customers are paying on average after 36 days, right? Or customers are taking 36 days to settle their payments. So this is the first way, okay, to calculate the days sales outstanding in receivables, which is also called collection period, which is also called receivable days. Okay, but there is another formula. This was the first way. And first way I told you, the first way. This is the first way. Now there is a second way to calculate the collection period. Okay. Now the question is that which which formula you will use in your exam. Definitely you have to check which data is available. According to that, you can utilize. And there is an alternative way which is written as a alternative way. Alternative way is actually your second way to calculate the account receivables collection period. Okay. Okay. The accounts receivable collection period. Second way is what? You have to take, this is the formula now. Days sales outstanding means a collection period. It's a day sales outstanding is the alternative name of the collection period I told you. Second way is what? You will take average account receivables as a numerator. Average I told you opening receivables plus closing receivables divided by 2, or last year receivables plus current year receivables divided by 2. And you will always divide with the total credit sales. Okay, total credit sales here you have to divide. Okay, and you will multiply then with the number of days, and number of days in a year, by the way. Okay, if you are calculating ratio on yearly basis, so it would be 360 or 365 days, and check the question how many days you have to use. Okay, this is the alternative formula. This will give you collection period also. Even you're using first way to find or second way, answer should be the same. Okay, and average receivables, again it is explained here, this average. Okay, this average. How it is calculated? Again, opening receivables, account receivables, okay? I mean, so trade receivables plus closing receivables divided by 2. And this is the alternative way. I hope so it is clear, right? Okay, these two ways you need to remember, guys. Now here, do you know that collection period, what does mean by day sales outstanding or collection period? It means on average how many days customers are taking to settle their accounts. Okay, so what is desirable? Lower answer is desirable, right? But again, I would not say that always look for lower answer, because it might impact your business also. Because you need to follow generally the industry norms. For example, think about your competitors, because ratio in isolation is nothing. You have to compare either with your last year or with the industry average or with the competitor. If your competitor is giving longer period to the customers and you are offering short period, okay, to the customers, definitely you will lose the customers, right? Because customers maybe they want longer period. So that's why I'm telling you, there is no, I cannot say this answer is good or bad, but you should follow the industry norms. Okay. Okay, now guys, here we are discussing few questions. Here you can get the idea. Okay, because this is what is the basic version of a ratio. So here we got a question. Now we are just going to solve this question quickly to see we understood this data or not. Can you go through this question, please? It's on your screen. Okay, so the question is they're saying the year-end financial statements for Queen Bikes reflect the data presented as follows. Okay, 10% off. This is important information. 10% of Queen's net sales are in cash, because mostly we use net credit sales, right, in the ratios. So they're saying that whatever sales are given here, 10% of that sale is the cash sale. It means 90% sale is the credit sale. Okay, here we got the data. You can see here year one, year two, year three. And here we got net sales, ending inventory, average receivables. Okay, net sales. He told you here in year one you sold 1,500 units at $100 each. So definitely if you will multiply units with the sale price, you will get the sale figure. In year two you sold 1,200 units at a price of 100. Definitely once you will multiply 1,200 with 100, so you will get the sales figure for year two. And year three, you sold 1,200 units with at a rate of at a price of $125. Then what? You got an ending inventory here, 100 units at 50, 100 units at 50, 100 units at 50. Okay, this is the ending inventory value. Okay, definitely if you will multiply, so you will get the value of the inventory. Then average receivables. So see, this is important. It's average. Average is already given. You don't need to calculate, guys. So average in the year one is $12,500. In year two, it was 12,000, and year three, it is $14,400. Then we got it here net income. In year one, it is 18,750. In year two, it is 9,400. In year three, it is $26,350. Okay. Now Queen's receivables turnover. You have to calculate turnover ratio for year two and for year three. That's the question. And if you will just go back and check the formula for turnover, I'm just writing a formula here first. Okay. So turnover ratio formula was, so turnover ratio formula was what? Receivables turnover. Formula was turnover. Okay. Turnover ratio. So formula was what? Net credit sales divided by average receivables. Okay, so now we have to check here. This is year, let's assume we have to calculate for year 2 and for year 3. Okay, and for year 3, same formula you will apply. Now look at here. So we need net credit sales. So look at guys, year 2. First I'm dealing with the year 2. This is the sales figure if you look at here. This is net sales figure for year 2. If I'll multiply 1,200 units time $100 selling price, so it is 100. Sale figure is 120,000. This is sales. And he told you 10% is the cash sale. It means 90% is the credit sale. This is what I want. So it means if I'll take 120,000 times 90%. So it is going to be 108,000 for year 2. Okay, 108,000 for year 2. Okay. Similar way, we will calculate for year 3 also. This is year 3 sale. So if I'll just multiply it 1,200 units with the selling price of 125, I'll get the sales of 150,000 total sales. And he told you 10% is the cash sale. It means 90% is the credit sale. So 150,000, if I'll take 90% of that, it is going to give us $135,000. So numerator we got for both here. Now we need, average receivables, and average receivables are already given. For year 2, average receivable is 12,000. Okay, I'll divide it $12,000. And for year 3 is 14,400. I'll divide with the 14,400. So now we will find out the ratios. Turnover ratio for year 1, 108,000 divided by 12,000. So we got 9 times for year 2. Now we'll work for year 3. So we'll take 135,000 and divided by what? 14,400. So it is 9.37 or 38 days time, sorry, times. So this is the answer, 9 times and 9.38. So you have to pick year 2 and year 3 because you have to calculate for year 2 and 3. In year 2 it is 9, in year 3 is 9.38 rounded figure. So here look, B option. In year 2 it's 9 because he's asking for year 2 and 3. So it means first figure it represents year 2 and second figure represents year 3. Okay, so B is the correct answer for this. I hope so it is clear. Okay, no, Muhammad, your answer was incorrect. Okay, now let's practice one more question here. You can look at here question. They're saying a company has question, another question. Okay, I would request you first go through this question, please, guys. Just go through one time by yourself. Then I'll show you how to solve it. Just read it. Ibrahim is asking 90%. What is 90%? He told you 90% is a credit sale, right? Because he told you here, if you look at it, he told you 10% of the sales figure, whatever is given, 10% of the net sales are in cash. But in ratio, we need credit sales. So that's why if 10% are on cash, then 90% should be on credit, right? Okay. Now, guys, here we go. Question. Let's go through. So, guys, need concentration here. So they are saying that a company has question. A company has 3 million per year in credit sales. 3 million per year in credit sales, and the company's average days sales outstanding is 40 days. So this is the collection period. Okay. I'm just writing information. Credit sale is $3 million, and collection period is 40 days. Now, assuming 360-day year, so not 365, 360 days. What is the company's average amount of account receivable outstanding? So he is asking you the average amount of receivable he's asking. It means we have to calculate answer in dollars because the receivables are always in dollars. Okay, so this is what he's asking. Okay, if now which formula I can apply? Okay, so this is what I need to understand. So most most probably, receivable figure, average receivables figure. So second formula always try to use first, if you remember, for the collection period. For the collection period I told you two formulas, right? Okay, two formulas. Collection period, the first formula was uh, days in a year, okay, divided by turnover ratio. This formula I cannot use. The reason, days in a year is given. Okay, fine. What about turnover ratio? Okay, and even receivable has not been used in this formula. I cannot use this formula because days in a year, turnover ratio. So this will give you collection period. There is no figure for receivables in this formula. I can't use it. I can't use it, right? Because there should be a receivable figure, then I can find in the formula. Now the second way. So it means this formula will not work. Now we have to check the alternative way. I told you alternative way also. Now alternative way I'm directly writing here. So the formula was for the collection period, if you remember. So the formula was average account receivables divided by annual credit sales or net credit sales. Annual credit sales, sorry. Annual credit sales. Okay. Okay. Multiply by number of days in a year. Days in a year. Multiply by days in a year. Yes, this formula can work. Reason, days in a year is given. Let's put the figures now. So collection period. Let's put the figure here. Collection period is also given. It's given how much? 40 days. Okay, we'll take 40 days. Equals average account receivables we have to calculate. Okay. Now net credit sale is also given. $3 million. Now multiply by days in a year is also given 360. Now can you rearrange this formula? How it is going to rearrange, guys? If you will mathematically rearrange this formula, how it will work now? Tell me. So it is going to work like this. Okay. So how, guys? So now formula will be credit sales. Okay. Divided by number of days in a year multiplied by collection period. If you will rearrange this formula will work like that now. Okay. Credit sale, which is given already. So just we are rearranging this formula. Okay. Rearranging this formula to find out this figure. Average account receivables. So formula will be rearranged like that. Okay. So average receivables equals net credit sales divided by what? Number of days in a year, or days in a year, and multiply by what? Collection period. Collection period is 40 days. Okay, can you just check now? Credit sale is 3 million, by the way. Okay, just put the figures. So 3 million divided by days in a year is how much? 360. Multiply by 40 days. Okay, just try first and then I'll show you one thing more. This is going to be $333,333. This is the answer. Okay, actually, once you divide, look at here, look at this side. Once you divide credit sale with the days in a year, like 3 million divided by 360, it will give you on average credit sale for 1 day. And for how many days our sale is stuck in receivable? 40 days. If you will multiply, it will give you 40 days sales, right? Okay. Is that clear, guys? Okay, there is other way. You can rearrange formula this way also, please. Okay, if you don't want this way, so you can rearrange this way also. More simple. Okay, this I wrote the direct formula. You can rearrange this way also. What? You can take this 40 days, right? 40 days, this collection period. Now this 360 you will bring here. It will be divided. 40 days divided by 360. Multiply this, multiply with the credit sales, which is 3 million. Okay, this will also give you average account receivables. Okay, guys, or you can write it here, credit sale here, and multiply 40 days here also. It's up to you. I hope so it is clear. Okay, now guys, we got other questions also, but let's, because these kind of similar questions will be there in your exam. Just practice. Questions are available in this sheet. Okay, plus you should practice questions from software. So now I'll move to the next ratio, guys. That's the inventory ratio. Relevant to the inventory. Again, for inventory, we got two things. Regarding inventory, we got two things. Okay, so what we got? One, we got inventory turnover ratio. And second, what we got? We got inventory days. Again, okay, inventory days. There is a other name also for inventory days. It's also called uh, days sales in inventory. Okay, days sales in inventory. Second name is what? Days sales in inventory. So these are the same thing. By the way, as I told you earlier, because connection I have already created means same concept you will apply. Just now you are dealing with inventory. That's the difference. So this will give you inventory turnover ratio will give you answer in times always, like receivable turnover. Okay. And this inventory days or day sales in inventory will give you answer in days or weeks. Okay, guys. So turnover ratio will give you answer in times and how, for example, and how you will interpret. So this, the turnover, for example, if answer is 10 times, again assume. This ratio will tell you how many times we converted our inventory into cash. Or in simple words, how many times we sold our inventory. That's it. Okay, 10 times, 50 times, 60 times. So definitely higher answer is desirable. Again, I'm saying. Then inventory days will tell you, for example, if inventory days is 30 days, for example, again, I'm assuming, it means on average, we are taking 30 days to sell our inventory, right? Again, if turnover will be higher, definitely days will be lower. And this is what is desirable. We are desiring for this. Okay, we desire for this actually. So turnover means that we should sell inventory more times. Okay, and we should sell inventory more quickly also. Now, the question is how you are calculating these ratios. Again, turnover ratios, how it is calculated. So here we go. Inventory turnover first. Dealing with inventory, okay? Turnover. How it is calculated, you will take numerator, the cost of goods sold. Okay. The numerator is what? Cost of goods sold. And you know this figure will be available from the income statement. And you will divide with the average inventory. Average inventory, again, how would you calculate? This is what is written here for average inventory formula. To find out the average, you need beginning inventory means a last year inventory plus ending inventory means a current year inventory and divided by 2. This is how you will get average. Again, if the business is seasonal, so instead of year average, we can take monthly average also. And for monthly, I already told you, you will take Jan inventory plus Feb inventory plus March inventory and so on up to December and divided by 12. If quarterly data is given, so quarter one ending inventory plus quarter two ending inventory divided by 2. Okay, this is how you can get the average. Okay, now this is what is turnover ratio. So guys, the main thing is what you need to memorize these formulas. And then what? This monthly I have already explained to you how you will find it. Okay, now I'm telling you here what's the interpretation. Interpretation I already told you for the turnover ratio that it shows that how many times we sold our inventory. Okay, or how many times inventory is converted into cash. That's what turnover ratio, inventory turnover. Again, now if you will look for inventory turnover formula, okay, what was the formula inventory turnover? Cost of goods sold divided by average inventory. Turnover formula is cost of goods sold divided by average inventory. Okay, I told you higher answer is desirable for this ratio. How this answer can be improved? Number one, if your cost of goods sold is higher, mean to say if it will increase and average inventory will decrease, automatically turnover ratio will increase. Okay, this is what they're saying. High turnover implies what it means. It implies strong sales. Okay, first thing is what? We have more sales, that's great. Or there is a or also, or that the firm may be carrying low levels of inventory. Because see, as I told you, turnover ratio could be higher only if cost of goods sold is higher. Cost of goods sold will be higher if your sale is high. This could be the reason. Or maybe the firm intentionally is carrying low inventory, denominator is lower. That could also, result in higher turnover ratio. Is that clear? Okay, then what? The point B, this is what I'm going to explain. Again, as I told you, what is desirable is higher answer, but you need to follow industry norms also. And it depends upon the nature of business also. For example, if you are dealing with the spoilable items like perishable items, for example, you are dealing with the dairy products, meat, these kind of things. Okay, if this is your business, so definitely then high turnover ratio is desired and it should be higher also because if you're not selling your inventory quickly, so these products will be spoiled. Okay, it will become definitely it will be out of use, right? You can't use it. It will become perish. Okay, that's why it depends upon the nature of business. On think on the other side, if you're dealing with the gold, silver, coal, these kind of stuff, if you're selling these kind of things, and definitely these things are not going to be obsolete, these things are not going to be damaged, these things are not going to be expired, okay, are spoiled. So in that scenario, high turnover ratio, and generally it is higher for them because it depends on the nature of the business. Okay, if you're dealing with the spoilable items, so we want high turnover and turnover ratio should be higher. But if you're dealing with other products, so it's fine if lower turnover ratio is there. Okay, or because as I told you, it depends upon the nature of the business also. But for a business perspective, you want your inventory, okay, to be sold many times in a year, more times in a year. Okay, now we are talking about here. First ratio is clear. Now I'm going to talk about days sales in inventory, and this is also called inventory days. Okay, second ratio, turnover ratio I have explained. Now days sales in inventory is also called what? Inventory days. Okay, it's called also inventory days. It is also called inventory holding period also. Okay, third name, day sales in inventory, or inventory days, or inventory holding period. So what it measures? It measures how many days on average a company takes to sell its inventory. Okay, if you are a businessman, so what do you want? Do you want to sell your inventory in few days or in many days? Definitely in few days it should be sold very quickly, right? So this is what they are saying. So day sales in inventory is also called inventory days and inventory holding period, and it measures how many days on average a company takes to sell its inventory. Okay, that's nice. Now the question is, how would you calculate inventory days or day sales in inventory? So again, there are two ways. So first way is this one. Okay, this is the first way. This formula is the first way. Look at this formula. And you have to check the question very carefully, what data is available, okay, and which formula you can apply. The first or second, I'll explain. So first way is what? Take days in a year. Again, it could be 360 days or 365 days, and divided by inventory turnover. And inventory turnover, if you remember, I told you the formula. It was cost of goods sold divided by average inventory. Just I told you, right? The answer of this formula should be divided here, which is inventory turnover. Okay, for example, 360 days, I'm assuming in a year, and inventory turnover is 10 times. So it will give you 36 days. It means like 360 divided by 10 times 36 days. And 36 days mean to say on average we are taking 36 days, okay, to sell our inventory. I hope so it is clear. Okay. Now, that's the first way. Guys, it's all about you should memorize the formulas, okay? And there is an alternative way also, okay, to calculate the inventory days. So second formula is what? This is the alternative way. This is second way, okay? Second way, okay? Or alternative formula. So how would you calculate inventory holding period or inventory days or day sales in inventory? How would you calculate? So you will take average inventory. Average inventory, you already know how to calculate. Opening inventory means a last year inventory, plus closing inventory means a current year inventory, divided by 2. That's the average inventory, and you will divide with the cost of goods sold. Okay, guys, sometime if cost of goods sold not available, you can also use purchases. Okay, but we'll prefer here to use the cost of goods sold. No, not here. Sorry. So that we will use in maybe in the payable. So you will use cost of goods sold here. Okay, sorry. So average inventory divided by cost of goods sold multiplied by 365 or 360 days, whatever is given. This will give you day sales in inventory. Okay, or inventory holding period or inventory days. Okay, guys. Okay. Now we got it here, third ratio, which is called accounts payable. Okay, accounts payable. So we have dealt with receivables ratios. If let me remind you, okay, we studied two: receivable turnover ratio and receivable days, which is called collection period also. Okay, and then we talked about inventory. Again, two things. We talked about inventory turnover ratio and inventory days or inventory uh, holding period. Okay, inventory days, second formula. And remember always, make rule of thumb. Turnover will always give you answer in times, even it is receivables or inventory or even payables turnover. So collection period will always give you answer in days, or inventory days will give you answer in days definitely, or weeks. Okay. Okay. Now we are talking about third thing, that's the payable. Again, accounts payable we are dealing with. So accounts payable, again, we will talk about two ratios. We'll talk about turnover ratio. Okay, and we will also talk about, okay, uh, that's called days purchases in accounts payable, days purchases in accounts payable. This is one name, purchases in accounts payable. Okay, or it is also called payable days in short, or payment period, payable days or payment period. Okay, payment period. Okay, this is these two things. Again, turnover, because now you are dealing with the payables and you should know payables are arising due to the credit purchases, and you are talking about now payable turnover and payable period. Okay, so turnover, similar way it will give you answer in times. Okay, for example, if it is 10 times, it means on average you have paid your supplier 10 times a year. Okay, that's turnover. Okay, and days, for example, days will give, all will give you answer in days. For example, if answer is 30 days, it means on average you are paying, on average you are paying to your supplier after 30 days, or you are taking 30 days to settle your payments, okay, with the supplier. So that's what is the payable days. Now here we are talking about the formulas. Let's talk about formula, how accounts payable turnover ratio is calculated. So here we go, accounts payable turnover ratio, how it is calculated. So first thing, you will take it here, purchases. Okay, purchases, because generally uh, credit purchases, right? Okay, or if you are using purchases, we are assuming it's a credit purchases. So purchases figure, and this you will divide with the average accounts payable. This will give you answer in times. Okay, again, average accounts payable, how you would calculate? So similar way, you will take beginning accounts payable, means say last year accounts payable, plus ending accounts payable, means say current year accounts payable, and you will divide with the two. You will divide with the two. This is what is called average accounts payable. Okay, guys. And now again, same thing. If business is seasonal, so monthly average you can also calculate, and I have already told you how would you do it. Now, guys, we are discussing here. This is what is accounts turnover ratio, and here is the interpretation. Okay, higher turnover. If just remember, accounts payable turnover ratio, how it is calculated. It is calculated per purchases figure divided by average accounts payable. Okay, now high turnover. When turnover ratio will be higher? If your numerator will increase or your denominator will decrease. Right? So your payable ratio answer will be higher, turnover. And when it will be lower, either if your purchases will decrease or your denominator will increase, so then this accounts payable turnover ratio answer will be lower. So now here, if answer is higher, if answer is higher, so what it means? So it means, it implies that firm is taking less time to pay off suppliers. We are taking less times to settle our payments. Okay, and it may indicate, because why we are settling our suppliers quickly, or why we are taking less time, maybe we are trying to take the advantage of the discount, early settlement discount, right? Sometimes suppliers are offering discount. But if turnover ratio is lower, it employs lower. I told you when it will be lower, if purchases are lower, or if your average accounts payable is higher, so then turnover ratio will be lower. So if lower turnover is there, it implies that the firm is taking more time to pay off suppliers. If you are taking more times, then maybe you are losing the opportunity to get the discount also, and you are foregoing discounts. Okay, that's what is turnover. Now let's talk about the second ratio, which is called days purchases in accounts payable. Okay, days purchases in accounts payable, which is also called payment period. Okay, this ratio, like how many days are payable days, payment period or payable days, any word we can use. Okay, so It's also called, look at the alternative name, days purchases in accounts payable, one name. It's also called days payable outstanding, other name. It's also called payment period, third name. Okay. It's also called average payment period. Okay. But the question is that what it means. It means how many days on average a company takes to pay its suppliers. Like how many days we are taking to settle our liability. That's called the payable period. And this is the first way again, as usual. So the first way, how would you calculate it? First way. The first way is you will take days in a year, which could be 360 or 365. Read the questions very carefully. Okay. Divided by average accounts payable. Average, I already told you how you calculate it. Opening accounts payable means last year accounts payable plus closing accounts payable means current year accounts payable. Divided by 2. This is how you will get average. Okay. So this will be the first way to find out. So what you have taken? Days sorry, days in a year divided by accounts payable turnover ratio, guys. This is a turnover, not average. So turnover ratio you have to take, and turnover formula was what? Purchases divided by average accounts payable. Okay, my bad. So this formula is what? Days in a year divided by accounts payable turnover. Turnover, just you calculate it by using this formula. This is the turnover formula. Payables divided, purchases divided by average accounts payable. It's actually a slip of tongue, guys. So second way is what? Second is, this is the second way. Okay. Alternative way to find out days purchases in accounts payable. Alternative way is what? You will take average accounts payable, and I have explained so many times. Average means last year plus current year divided by 2 and divided by cost of goods sold. Okay. If cost of goods sold is not given, so here you can use credit purchases also. Okay. If cost of goods sold is not given, credit purchase can also be used. Credit purchase is not given, it can be substitutes with the cost of goods sold. It's fine. So I'm just putting here average accounts payable divided by credit purchases or cost of goods sold. Whatever information is available, you can use that one. Okay. And multiply by 365 or 360, whatever days in a year, you can use that one. Okay. So if you will apply this formula, this will give you payment period or days purchase in accounts payable. Okay. So this is how you will calculate it. So I hope so, guys, it is clear. So any questions so far from here? Okay. Now, once, once. So, guys, here we are talking about uh, because let's assume if days purchases in accounts payable is 40 days. Let's assume payment period is 40 days. We are taking 40 days to settle our payments. So it can be compared with the average credit terms offered by the supplier. For example, your supplier offered you 35 credit days, credit period 35 days, but you are taking 40 days. It means you are making late payments, right? There could be a penalty also. But if credit period which is offered by supplier, I hope so you know the credit period, right? If credit period is offered by supplier is 35 days, but you are settling in 30 days, or maybe you are settling in 25 days. So maybe you're trying to get a early settlement discount, right? Okay. So this you can compare the payable period or payable days can be compared with the average credit terms offered by the supplier to determine whether the firm is paying its invoices on timely basis or too soon or maybe too late. Is that clear? Any questions so far, guys? Please confirm through the chat option. Any question, guys? Okay, guys. So what we will do in the next class, I'll cover the remaining part, the operating cycle and some theoretical aspects, and we'll practice the questions also. Okay. See you next time. If you have any question, you can ask me.